Hi everyone, welcome to the panel. So sorry about the silence. We're just waiting for the audience to fill up, and then we'll kick off. Give us a minute or so. We're just waiting for the audience to sign into the Zoom. Okay, we're going to get started as sort of people come in. So hi everyone, my name is Vikram Viadyanathan. I'm a partner at Matrix. This is sort of an initiative that we do, which is State of the Fintech Union. This is our wealth tech panel. Super excited about it. Our partners in this are BCG, and that's Mayank, who's moderating this alongside us. And they've actually done the hard work around this. The reason I'm super excited about the panel is when I was checking out everyone's background, each person has done only wealth in their lives and pretty much nothing else. And they have been doing wealth for, at least a decade or more, each of them. So super excited about the composition of this panel. So I'm going to hand to introduce each of them and get into it.
Thanks. Thanks a lot, Vikram. I hope the screen is visible to you. Very excited to have this conversation with all of you. We have a very esteemed panel with us today on the discussion on wealth tech and the entire balance between innovation, sustainability, and regulation in this space. On the panel today, we have Navneet Munot, who is the MD and CEO at HDFC AMC. Navneet has been in the wealth management industry for 28 years. Before leading HDFC AMC, Navneet led as a CIO at SBI Mutual Fund. He's a CA and CFA. We are also joined by Nithin, founder and CEO at Zerodha. Nithin has been credited by creating the largest discount brokerage in the country in a very short span of time. Zerodha was founded in 2010, and today it's a 9 million plus clients. Nithin also has founded Rainmatter Investment Fund, which looks at fintech and incubation in the space. Sandeep Jethwani is the co-founder at Deserve.in. Deserve is disrupting the wealth management space in the emerging HNI segment. Sandeep has been a lifer at IIFL Wealth before this. And he has been one of the founding team members there. Yatin is the co-founder and joint CEO at IIFL Wealth and Asset Management. Yatin again has spent a lot of time in the industry before IIFL Wealth and making IIFL Wealth to what it is today. Yatin, prior to this, has also started his career with Kotak. That's who we have. We have a great set of people with us. I want to walk you through a couple of pages to set the context for the discussion. Wealth in India has grown tremendously. If you look at the financial wealth, and we do a global benchmarking around how wealth is evolving in every country, wealth in India over the last 20 years has grown 19 times. If you look at some emerged markets, that growth has been only 2 or 3x. So there's a huge growth on financial assets that have happened in the country. However, the dichotomy remains that wealth is still concentrated in a few high-end pockets. There is a mass democratization that has started happening, but there is a great potential to take wealth to more hands than what it is today. And wealth tech is the space where a lot of players are trying to disrupt this and take this as an opportunity going forward. We spoke to a lot of incumbents as well as emerging wealth techs on what do they see as top priorities, and this was done as a part of the survey at Soft2 this year. The clear emerging priorities that we see in wealth management space are around product expansion, having the right sort of talent, looking at regulatory impact on business models. This is the space where regulatory impact compared to other business lines of fintechs has seen a much more importance. A more regulated space and creating opportunity here becomes challenging, and it remains a top priority for the players. However, this space is also very clear in terms of identification of disruption potential. There is a clear recognition that investment advisory as a space could be hugely disrupted. A clear area of disruption remains in that. Mutual fund space can continue to have more and more innovation around it, and that comes as the second priority from the survey. And the third is, how do we look at token assets, newer alternative assets which can disrupt here. If you look at what are the key challenges that come across in terms of growth and sustainability, you'd see that wealth as a column stands out a little different from the other columns here on this page. And the reason is that gray box which is standing out there, and this will be one of the most important parts of the discussion that we would like to have today. Yes, there are regulations, and that's an important challenge that everyone has, but true monetization capability in the way the wealth industry has evolved in India today continues to remain a challenge. How do we make business more sustainable is something that we'd like to cover with the panelists today. As we look at regulations, I think there is an interesting debate, and we as panelists were talking just before we got into this discussion, is whether the regulations favor more the incumbents or favor more the wealth techs. There have been a lot of relaxations which have been done to enable a level playing field, but this is something that we would also like to have a discussion today. Cost of acquisition, specifically from a wealth tech perspective, is an important area to address, given that the monetization opportunity remains very thin in the industry. We also asked about some of the recent regulatory changes that have happened. Whether it is pooling of funds, discontinuation. Half of the respondents had a neutral outcome, neutral outlook on. On mandatory two-factor authentication, largely audience believe that this is a positive outlook. As far as cryptos, NFTs, and other alternate assets go, there is a view that cryptos and NFTs should be allowed in free market with regulatory oversight. There is a good amount of agreement. And there is also an agreement that regulatory uncertainty today is affecting innovation in these new asset classes. So as we touch upon topic of innovation, we can have discussions around this. The industry in India is largely a distribution and a commission-driven industry. However, it is seeing a shift to advise. It is seeing a shift to advisory as a model. Now, this is a place which can provide a fillip to the industry. This is where mature markets have moved. They have had their evolution journey. They've had their business models which have led to this evolution. And there is a large view that there needs to be a relaxation in RIA versus distribution regulation in terms of the business that they can do. Tokenization is seen as a interesting opportunity, which will enable large ticket investments available and large ticket illiquid other investments available to more investors in the future. So this is an area that has been identified as a great opportunity. And another interesting topic that we would like to have a discussion today is how do we ensure that Indians have access to cross-border investments even more than what it is being done today? So how do we have a better regulatory environment in support of cross-border investments? Accredited investor norms which have come are being viewed very positively across the industry. There is a strong belief that it will bring in new customers into the foray, and this is something that will unlock growth, especially in the emerging HNI segment. Coming to AMCs, and we have two AMC panelists here as well. The outlook on changes that have happened on the AMC side on regulations is largely being viewed favorable both by incumbents and by the challengers. Whether it is smaller AMCs being allowed to have higher TERs, relaxation of net worth requirements for the promoters, or leadership compensation linked to performance, being seen as a positive in the industry. And when it comes to the latest regulations in customer charges, it is being seen that the lower net worth requirement to float a new AMC is, in some sense, a little bit unfair to the incumbents. So these are some of the findings that have happened, and there's a list of things that we want to cover today. But I would start the discussion now, with the panel taking some of our pages off and having their beautiful faces on the screen. Let me start with you, Nithin. Nithin, there has been a lot of innovation that you have driven, in the business that you have run. You've been the pioneer for many of these models in India. That's been on the transaction business. As we look at wealth and advisory business, where do you think there is an opportunity for innovation? Is the innovation at the same place as lending and payments that has been seen in India? Where do we see this moving in terms of innovation?
Yeah, thanks, Mayank. This is a question we've been asking internally for a while, saying, we've introduced millions of customers to the market, and the objective was really to help them do better with the money. And the question is, are they actually doing better with the money, right? And And we've been thinking that maybe not, right? As in, just because the platform is easy to access, it's got all the tools and utilities, we have education initiatives, doesn't mean that people know how to use all of this, right? And there's something that we've been working on, saying, what next? As in, there's no point if you introduce customers and they become inactive because they made a money mistake. So one of the way we've been approaching this is to say that, can we somehow find ways to, get people to avoid money mistakes, right? It's very tough to kind of advise and tell what is the right thing to do in life, because it's very contextual, it depends on the person. But the money mistakes are very common across, right? As in, don't go against the trend, don't average down, don't get concentrated, don't, if you're buying penny stocks, buy very little, even if you want to do it, and stuff like that, right? As in, so our approach to this, helping people do better with the money has been to see if we can find ways to nudge them away from the money mistake. And we realize the best opportunity to do this is really in the order flow, right? Because today what happens is people are so distracted that, whatever is I mean, the emails that is regulatorily mandated, and it's important to read, the open rates are like 3-4%, right? I mean, we send not more than one push notification a month. So, we're like, at least if we send fewer, far between, probably the open rates will be higher. But like people don't care about it, right? So how do you really, help people do better? As in, if they are not interested to kind of, look through any content, right? But what we realize is that when a customer is placing an order, that is, he's seen a stock, he's decided to transact, and he opens an order window. For those few seconds, those 3 to 5 seconds when he's confirming the order, at that time we have like undivided attention from the customer. And that's where we realized that we can actually nudge the person, significantly. As in, our first nudge was really this whole penny stock thing, where we scare the shit out of the customer when he's buying a penny stock. Our penny stock trading volume as a percentage of our equity volume is down almost 75-80% from the time we introduced. So what we've kind of realized is that maybe that's really the best place to do it, right? As in, it's very tough to figure how else do you get the customer attention. So what is the innovation? I don't think lending is going to be an innovation. I mean, it's, like there is, I don't know. I mean, lending on an investing platform isn't even, I think, the right thing to do. So, and also, there is a bunch of regulations, circulars that were released by the exchanges in the last few days, which very clearly says that the broker can't have any kind of relationship with any lending platform. As in, you cannot subtly even push lending. So lending is out of the question. Payments on an investing platform, I don't know. It somehow seems, of course you can do it, but does it really add value to the customer? I don't know. So I really think it is, for an investment platform, it is really to help people do better with the money, which is advisory, right? So whatever innovation has to happen in the advisory side to help people do better. So
Nithin, one of the things that I've heard from many people, including some of the panelists, is the right entry product potentially for investors is could be debt, right? But
right.
Given that you get so much exposure, that ends up being the entry product, and then it puts off investors and so on. So sort of two questions. One, what separates HNI money, which is what everyone wants to manage their money like, is there's much more debt participation. Surprisingly much higher with the HNIs. And second is it's much more active management, both of which are not present at the retail level. Right. So talk a little bit about that, and I'd love for Sandeep and Yatin, because you guys have been helping HNIs manage money for so long, on how sort of both that debt and active management comes into product innovation.
Yeah, no, I think the HNIs have better expectations set from the markets than retail, right? Because, if you were to go to a retail customer and say, you can make 10-12% from the market long term, he'd be like, dude, why even do it? I'll put money in fixed deposit, right? As in, so the interest really comes only when, you say 15-20%, right? That's really why he's taking risk. So that 3-4% isn't enough to move the needle for a retail investor, right? And that's the reason there aren't any takers really. I mean, we've experimented with a bunch of things at Zerodha as well, and very few takers for debt products at 8. I mean, like, where 1-2% over fixed deposits. But if it was 4-5% above fixed deposit, then there's a lot of interest, right? But then at that point of time, there is risk as well, right? But the problem with retail is, as soon as greed takes over, they ignore risk, right? And so for a platform like us, it's a very, thin line of sorts, and because we don't want to be nudging greed to get a transaction. And so what is the stance we take? So, but yeah, personally, I think debt is the right starting product, but debt is too boring, right? A lot of people who come to the market come for some entertainment as well, right? So, so it's, I think, while debt is the right starting point, I think it's very tough to get retail investors to invest into debt on a platform like us. People prefer to just book a FD or something like that.
And we can add, like, the moment you look at the higher yielding stuff, you end up looking at binary outcomes. Like, either you will get the return and the capital back, or you'll sometimes not get it, right? And therefore, within the HNI community, there is openness to looking at package solutions around this, where multiple debt products are then combined into a single sort of a structure, sometimes AIFs, etc., where there's a greater ownership on the side of the asset manager, where they are creating, managing, and so on. And I think similar structures will have to evolve on the retail side, if at all we have to focus on high yielding fixed income. Single instrument fixed income obviously comes with its whole set of risks, and I think that is a challenge. But and to the point that earlier was made about what is the innovation that can happen, there I strongly feel that the level of innovation will have to happen at a higher level of abstraction, in a sense that it will probably not happen in the instrument selection process or recommending individual instruments. It will potentially happening at the solutioning level. And today, one of the things that we are extremely enthused by is the willingness of investors to transfer meaningful sums of money online. And this is a behavioral change. The comfort, the trust that investors have with digital platforms is far more than potentially a few years ago. And therefore, if we are solving at the solutioning level, I think our focus will have to be around user-first thinking. Like what, and sometimes there is a tendency of us, and most of us come from the financial investing side of the business, and therefore the tendency to offer what we can and want to offer, as opposed to really putting ourselves in the shoes of the investor. And whatever we have done at Deserve has been focused around that user journey and how we can optimize for that.
That's super interesting. And Yatin, I'll come to you. But Nithin said order flow, you're actually saying higher level of abstraction. And so both of you are actually talking about tech in the user experience, actually delivering the innovation versus the hard financial product. Sorry, Yatin, go ahead.
No, coming from the segmentation perspective, I think retail to mass affluent to emerging HNI, then to ultra HNI. I think from a return expectation, the retail is that wants to do wealth creation through investing, and from the ultra HNI is looking at the wealth preservation, right? So the return expectations truly differ a lot. And clearly said, as you move up the segmentation chain at the level of engagement and the activity solution required is different. And that brings down to, I think, the cost to income ratio, the cost to serve ratio, or the CAC becomes extremely different kind of segmentation you are trying to focus on. Looking at, I think, trying to be on the technology side a lot. I think where the DIY, which Nithin has clearly mentioned, I think the mass affluent part is where the mass, the scale will work, will be solution providing. And there, I think the fix, what some of us are trying to figure out is what regulator is deciding, how can we make money or who can make money. And that's where the engagement of broker versus the distributor versus the advisor versus the manufacturer. What we're trying to see, wanting to provide solutions, but right now the person who has the ability to earn money by providing solutions to mass affluent is the manufacturer. I think what we're trying to figure out, how a broker, distributor, and the advisor can also earn money for providing those solutions to the segment. Clearly, I think nobody disagrees on the tokenization part. I think whatever is available to ultra HNIs at some point in time, the regulatory framework and innovation and technology will allow that products to be available to, I think, everybody. That's no doubt about it. But the regulatory framework sometimes is not allowing you to service that segmentation, because we still figure out how to charge fees or charge brokerage or earn commissions from that. I think what the way the regulatory framework so far is, looks like the manufacturers providing a solution is able to earn fees. The rest is figuring out how to do it.
Even just picking up from what you said, there needs to be more solutioning around the mass retail customer. Navneet, wanted to get your views. I mean, mass retail participation has happened a lot, just by the structures through mutual funds. And in mutual funds, we have seen now, a host of constraints that have come in terms of, how you can label your product, how many products per category that you can have. So too much regulation, is it stifling innovation? What do you see on a day-to-day basis? How do you differentiate what you can offer and what you can create as a solution versus others? Navneet, you're on mute.
So to see the genesis behind that categorization that you referred to. So this was done to ensure products are true to label and there is a comparability. The regulator wanted the standardization, and this was done in wide consultation with the industry. In fact, of late, we are seeing a lot of efforts have been made to even standardize underlying benchmark indices also for further improving the comparability across products in every category. And talking about the genesis again, so one has to keep in mind the level of financial literacy in India. And then that's why protecting the investors' interest has to be paramount for the regulator as well as the industry, because here you are serving a mass market, which is what you talked about. The other way to look at it is there is there is a lot more to mutual funds than the category they fall in, right? I mean, one can achieve differentiation through investment styles, your approach. I mean, one is top down, one is like bottom up, for example. The active share that one runs in terms of sector or the stock bets, concentration, portfolio turnover, etc. etc. And even the brand positioning, marketing, visibility of a fund in the same category can differ from fund to fund. And in fact, to cater to mass market that you asked, I mean, if you look at the current categories, there are enough in India. I think almost, if I remember correctly, 13, 14 in equity. There are like 14 plus in debt across duration and credit buckets, a range of hybrid funds. I think there are some 5 or 6 categories there. And then there are solutions product, I think for children or retirement, etc. You can launch fund of funds to create solutions on top of that. Then on top of that, there's a lot of flexibility in the passive category, the products that you can launch. And you, again, I mean, you have the PMS or the AIFs I mean, if you have a highly specialized product for a niche audience. So that way, I think that there is enough, I would say, scope for innovation in the industry. And your point on is too much regulation stifling. I think SEBI has always put in a great deal of thought into its regulations, keeping in mind the benefit of end investors, what I think Nithin talked about in a different manner, or what Sandeep referred to earlier in a different manner, because you have to keep in mind the benefit of the end investors, and particularly when you're dealing with the mass market. I mean, again, repeat the same point that financial literacy in India is still a long way to go. So I think the regulator has to keep that in mind. But I mean, talking about the innovation, different people, Yatin talked something different, and Sandeep talked about something. Honestly, if you ask me, I mean, true innovation is like, how do you optimize the outcome for the investors over a long period of time? It's about how to ensure utmost transparency. I mean, and if history is any guide, and you can look at the excesses that have happened in some other markets recently, also in last few years, innovation just for the sake of it may not be a good idea. I think sometimes simple or the boring stuff that you do may be good for a very, very large segment of the market. Yeah.
I mean, a lot of people have benefited from your investment philosophies over long periods of time. Just shifting gears, some shifting gears to how do you monetize, in this space. This is an important area, and maybe Nithin, we can start with you. We are going through a period where there are a lot of investors coming in, many of them coming through direct routes. Literally there is limited monetization opportunity that you see in pure wealth management space for wealth techs. Is the way that we need to move towards manufacturing and capture value there, or is to a transaction model? How do we make this work so that there is more interest in this space, from the supply perspective as well?
Sorry, Nithin, I'm just going to add some specificity to that question. And I was reading this "Can the brokerage industry survive?" article that you guys had put out, right? And there's a bunch of things that are prevalent in global markets. I was looking at Interactive's P&L. I was looking at Charles Schwab P&L. And so there's order flows that are allowed. There's securities lending that is allowed. There's a bunch of revenue streams that make these valuable businesses. And therefore, you can actually also then deliver more value to the user, some of which you can't do in India. So what does it take to get into all of those revenue streams?
Yeah, so some of them are quite convoluted, to be very honest. So I think, it's right that we don't have them in India. Like, for example, order flow, which probably today is the most revenue for most discount brokers in the US, is essentially, when an order comes on the platform, they send it to the Citadel, 2 Sigmas of the world, and they get paid like 13 mils an order, per share actually, right? So now the Citadels of the world can either fill it themselves or, kind of fill it on an exchange. It's a very convoluted practice. I don't even know how, that's still being allowed. It was actually started by Bernie Madoff, because he was the first guy who started buying the order flow. So, and it's just, the US, the whole broking industry has a lot of lobbying power. And I think that's how this has managed to survive for this long. Securities lending. So for example, in India, when you buy a stock, it sits in your demat account. Whereas in the US, it's most of the people open a margin account. So it sits with the broker. The broker in turn can lend it and, kind of earn a lending fees. So again, very convoluted practice, because without the customer knowing, you're actually lending the customer securities to someone else. So I think it's not right for the customer to do stuff like this. And what's not right for the customer can't be right for the business. Of course, in the short term, it can, but in the longer run, one incident is away, like if you would ask me, one of the reasons why so many people have come to the broking, to the markets also because people feel safer today, right? As in corporate governance has improved, as in, it can do a lot more, but it has improved. As in SEBI has taken all these actions over the last few years that has made people feel safer trading, investing with a broker. Something which doesn't get spoken about too much is that people feel safer. Now the thing is, how do you make money? I think there's a way to make money in the broking business, because it's a transactional business. 80% of your business, of the revenue will, 80% of your users, 80% of your volume will come from active traders who wouldn't mind paying small amounts of money. Right? That's how we make money. As in, we, in hindsight, it was planned very well, but this was not really meant to be. When we started the business, our focus was to build a business for very active day traders and futures and options traders and speculators, right? This whole extending it to investors happened afterwards. So, so we had already built a business around the most revenue generating users in this country. And that's how, we could actually build a large business in terms of revenue and profitability as well. And that market is growing, it's growing slowly, but it is growing. The number of people who want to actively trade, speculate. We started this whole trend of zero brokerage for equity investing, in 2015. The reason we started was because at that time, people, we were getting labeled as a broker to be used only for speculating. If you want to invest, use ICICI. If you want to trade, use Zerodha. And we wanted to kind of break that image. And we said, why not make it zero brokerage? So, we, even investors look at us. I think at some point of time, you have to start charging a transaction fees for, equity investing, given the fact that, like in the US, there is no order flow income, or there is no securities lending income, or, any of those other ways to generate revenue, especially with some of the new regulations that SEBI has brought through. It's really, really hard for a broker to generate any revenue from equity investor today. I think we went zero, and then the whole industry, like the whole section of the industry went zero. So now I guess as times get tougher, someone's gonna blink, and and there will be some cost to it. So as long as you're earning a transaction fees, there's a way to make money. I think the issue is how much do you spend to acquire a customer? Right? Today, some of our competition spends between 3,000 to 5,000 rupees to acquire a customer, and it's very tough to make money spending that much money. So at the current rates, the only reason we have survived is because we have spent zero on acquisition. Like I was just telling this to someone, all our revenue, we have 10 million customers. If 10 million into 4,000 is 4,000 crores. If that's all our profitability till date, right? So if we had spent, 4,000 acquiring customer, we would be a loss-making company. So the difference is that, if you're going to go acquire customers paying 3,000-4,000 rupees, it's very tough in India currently to be able to generate enough, to kind of be profitable, sustainable. When we started the direct mutual fund platform, we were charging 50 rupees a month to use it. I mean, the amount of fire we got for that was just intense. I was like, that was 50 rupees a month. And people were managing the customers with crores of rupees in their portfolio. And they were like, I need to pay 50 rupees to use your platform. I'm like, dude, what's wrong with you? So yeah, so it's tough.
So what's the answer? And Sandeep, you've seen both sides of this. Having run IIFL 1 and then now at a wealth tech. So is the answer just trying to figure out how to make more money from distribution, or is the eventual answer everyone is an AMC? What is, or can you actually make money from advisory? What's the answer?
So Vikram, the thing is that there are multiple answers, and going back to the point I made earlier is that this is not one single type of user, right? There are multiple different types of users in India. Like the ones that we end up working with are people who have a meaningful sum of capital and let's say a few lakhs or more, and who want somebody else to own the investment outcome or somebody else to manage the investment outcome, right? Now, if I look at that particular segment, what do we do for them? We figure out the right asset allocation for them. Within that, the right sub-asset allocation, then the right instruments, then managing it on a daily basis, then figuring out when to rebalance, when to top up, when to redeem, all of that stuff, right? So at the end of that journey, the user is willing to let you make money, right? And we tell them exactly how much we make. So in the process, what we have realized is that the bar for paying fee or letting the platform make money is very high in India relative to possibly other countries. Like look at potentially education counseling in India, right? I mean, there are so many options, but in terms of educational choices, but we still prefer to ask our friends and family on where do we want to study. We don't want to go to that educational counselor who will pay us, who we will pay to get that feedback. So the point is that the bar for sort of payment of fees or being able to monetize the user is much higher in India. And as we realize that, let's say whatever we've done with our integrated portfolios, etc., there is a willingness among that user segment to pay. Does that apply to all user segments? Potentially not. The guy who wants to figure out themselves on how they want to invest potentially doesn't want to pay. And they want easy access, low cost, etc. So I think, to my mind, it's India's like many Indias within, and we have to figure out our India that we have to work on.
Just to add one more thing, so this is something I've been bringing up to regulators. So the thing is, if you want advisors to flourish in this country, you need to make it easy for them to collect the fees, right? I mean, you cannot expect customers to pay at the end of every month through a check. I mean, who's going to do it? I mean, like, no, I mean, there should be a way to collect the fees from the AUM and pay to the user. I mean, pay to the advisor. That's the only way this is going to expand, right? As in, and this is something that I keep bringing it up because, India needs more advisors. I mean, the financial literacy in this country is so low, and we need like this, tens of thousands of advisors turning, millions of Indians professionals in terms of money. And for those tens of thousands of advisors to happen, platforms like us who have access to the customer AUM should be able to debit the fees and pay to the advisor, as long as the customer consents, right? As in this whole taking money directly from the customer, it's not going to work. And I think one of the reasons why the US is such a, well-developed market is that, right? As in, the fact that advisors can very easily collect their fees. Otherwise, advisor ecosystem won't exist. And the big problem for, regulated advisors today is, they're competing with influencers, etc., who can claim whatever they want, right? They can claim whatever returns, and so it's tough, so I think we should make it easier,
So,
Mayank and Vikram, if I remember, I think on one of the slides you show that, you showed that are the customers willing to pay for the advice? And if I remember correctly, you had like 45% people said yes and 35% said neutral, which means and only 20% said no, they are not willing to pay. But what we heard from Nithin, that even a $50 per month for a person who has a 1 crore rupee is like too much to pay. So,
Navneet, be clear, the survey respondents are wealth tech professionals, so they want to pay. So
they want funding from metrics. So.
There is a hope that they will pay, and hence we should put up a model out there.
Yatin,
great.
You guys have built an advice. So tell us what's the secret sauce.
No, so coming back to monetization, I think definitely it's not. There is a regulation, and I was about to make that point. Nithin made a very, very valid point. About you can't expect an advisor to wait for the end of the month to collect the check. I mean, there is a way to collect the fees. And that's where I think some of these enablers, which will fuel the market for mass affluent or emerging HNIs. Today, we are providing solutions on the wealth management side. We are providing solutions on asset management side. We are collecting fees on the wealth management side, and we are charging fees to investors on the asset management side. I think the question ahead of us is when we democratize this and go down the segmentation of retail and mass affluent, whether the regulation is allowing us to do the same thing which we are able to do it in ultra HNI. And that's where the cost of acquisition also comes in picture, because one is allowing the platform to kind of provide those services and collect the fees, and second, seeing at what is the cost which is going to acquiring that customer. I think that is where I think what we are finding it difficult to understand. There's a partly whether that consumer class exists where fees will be collected and paid, and then second is the regulatory framework which is not enabling us to do that.
So I think just before this panel started, Mayank and I were perhaps harping on the fact that, what regulations do you need? And all of you guys almost universally said, actually, the regulations are okay. The enablers need to catch up. So talk a little bit about that. I think AA came up. I think we've heard KYC come up in different ways. There's now a way to collect fees. What are the enablers that are needed where the regulations allow something, but the enablers aren't there?
I think starting, of course, the first point where we all are into direction that the market eventually is going to move towards transparency, alignment of interest. All service providers, both sides need that your advisor has completely aligned with the investor and would want outcome is, and fees are based on the performance and so on and so forth. So all that is absolutely given, and market is going to move rapidly towards there. I think challenges light in all 3-4 things. I think one is operationally how even today onboarding of clients which are taking place, PMSs, alternates, power of attorney, custodian accounts. I think there are some frictions which still exist, which is not allowing completely seamless onboarding online. And then comes the, of course, some bit of challenges, which is terms of tokenization of some sophisticated products, alternates, which can also become a part of all investor portfolio, not just ultra HNI investors portfolio. And third thing is things to do with the regulations around your manufacturer, advisor, how you collect fees and charge fees, and so on and so forth. Yeah.
Go ahead, anyone.
Yeah. No, I mean, like, we were saying, so I think for this advisor, for the mass retail kind of platform, I think we need access to that whole advisory, account aggregator ecosystem, right? As in, if you can't really call a customer and ask for all, his holdings and etc. Right? So there should be like a one-click way to do it. Now that there are the, account aggregator framework in place, I think it's just about, getting the depositories on it. I think the insurance regulator is already on it. IRDA is on it. Banks are slowly getting on it. So eventually it'll probably, like on platforms like us, we could have a one-click, and say, what, this is your assets across, and maybe you don't have the right asset allocation. Do you want to talk to us? And
where do you think that is? Is that a will issue where people don't have, or is it just an alignment of incentives? Where if I actually have this data, what is my incentive to share it with everyone else?
No, you're talking as a FIU, is it? As a FIP, as in
FIP.
Yeah. No, I think this whole account aggregator, I think SEBI, I was not in on it, but the chairperson came on, said that they will get on it in the next few months. So I think it's on the way. So I think by the 1 year or so, I think depositories will be on it. So once that happens, I think it is possible to kind of build like this whole advisory platform for the mass retail. But the issue here is is somehow setting the expectations right, in terms of what to expect from the markets, right? As in, and there's a lot of problem, I think, right now in the ecosystem, not just in India, across the world. This influx of influencers, who are almost making it seem like making money is easy and guaranteed, on the stock markets. So, and when people come to you with that expectation, whatever advice that you can logically offer will not seem worth it. As in, it's a, I think we need to find some regulations to kind of go after that as well. As in, you can't just allow people to claim whatever they want. As in, even if they are claiming, they probably should have some disclaimers at least in place, which is to.
You're saying accountability for influencers and things like
absolutely,
that.
Absolutely, yeah.
So accountability for anyone who is basically giving advice in any form.
Yeah, just because you're giving it free of cost doesn't mean you can get away from the accountability. See, the thing is, back in the last bull market, you had this whole advisory tips giving ecosystem, right? People used to share tips and charge money, and then that was a big problem. And SEBI came and put in this RIA regulation saying that if you get a fees from the user, you come under RIA. You have to register as one, right? You cannot provide tips for a fees. The problem with this whole current ecosystem is that you can be on YouTube or wherever and make content and earn from the platform and not from the user. So you're kind of getting away from the need of being an RIA. And now the thing on this platform is the content discovery, etc. The more louder you are, the more clicks you get, right? Or the more views you get. So there's almost like an incentive to just be as loud as possible, right? And that is, I think, setting wrong expectations in at least the current under 30 guys who are kind of coming to the markets, and we need to fix it because wrong expectation, they'll get disappointed soon. If they get disappointed, they're not come back to the markets. So it's, yeah.
So maybe
when you said under 30, I remember, I think one of the ads shows, I mean, a small kid making a lot of money in options and the whole hall claps for it. But that's under 13. I don't know regulatory, I mean, whether that's allowed. Somebody can trade if you're below 18.
No, you can't. You know, people claim that they're trading in their parents' accounts and stuff.
Nithin used to before he was 18, but
mother's account.
Navneet, the next one to you, and as we come to regulations, this is the discussion that we were having just before the panel started. You have been an incumbent, in the manufacturing space, and we can talk about, both as a manufacturer and a distributor. Do you think, regulations today are providing a level playing field between manufacturers and or the incumbents and the challengers? What is your take on it? There have been many regulatory tweaks that have been done today to allow more participation in the markets. Having more players come in. How do you see this?
So talked about some of those tweaks, and regulations keep changing in line with the industry dynamics and the incremental needs of the investing public or the investing environment to create the right conducive environment. I mean, are there significant advantages or disadvantages to wealth tech versus traditional manufacturers or distributors where growth is not possible? I mean, ultimately, regulation focus on the investor interest. Recently, you have seen how regulation has changed to promote ETFs, for example, or the overall passive side. And then some of the players, Nithin has talked about it, a lot of other people who are entering that space, and some of the fintechs have aspiration to build a business on that side. And they would have been very pleased with those changes. And same thing can be expected on the other side. Like I think Yatin or someone talked about the accredited investor and the whole democratization aspect. Talking about that manufacturing, it's about building the investment capability, investment management capability, your risk management capability, and product management capability in an integrated manner. These three working in tandem with a deep sense of client centricity. Given that India is an open architecture, on the business side, manufacturers work with like all kinds of partners, including the wealth tech, in a completely open architecture distribution framework. And I'm leaving aside few large banks which are closed or guided. But by and large, you are an open architecture in India. So there is no advantage or a disadvantage to anyone, as long as you have a great proposition for investor. So the space is evolving, and regulator has been open to ideas subject to core principles of what they follow. Putting investors first. That has to be the core.
So Navneet, when do you start trading in crypto? And
I think I said putting investors first. We have to make money. I think our funds have delivered like 18-19% CAGR for 25, 27 years. We take pride that if you put like 10,000 rupees per month, and I was very happy to say, I think Nithin mentioned one of our fund in one of the interview in Mint that he's been holding it or doing that SIP for a very, very long time of that 10,000 rupees. So had Nithin started few years younger, the 10,000 rupee per month would have become several crores. So I think that's more important for us than trying to, I mentioned earlier, innovation for the sake of it doesn't really make sense for us. I think investing is about doing the simple, boring things over a long period of time.
Great answer. And, I was looking at the Q&A and there's a bunch of questions around crypto. And, maybe just quickly, whoever has the strongest point of view or maybe some insight on when India becomes, part of this crypto ecosystem, or should it at this point in time, given where investors are?
I think, Vikram, look, India, there's a long way to go for investors to enter even equity markets, right? There are only 2.5 crore active accounts potentially on the NSE side. So there's a long way for users to enter. There are questions about fixed income not happening in India very actively. Mutual funds are only like among a very limited set of investors. So I think it's important for the regulators to focus on doing that segment as opposed to for worrying about this crypto animal for now. There is some time away before they will get to it, and probably that's okay for now.
In India, where 65% of the assets are in real estate and gold, and maybe a large part in bank deposits, I think equity is an alternative.
Yeah.
I mean, that equity itself is like what we know as alternatives in some of the other parts of the world, as Sandeep rightly said.
So we have some questions coming from the audiences, and we'd like to take a few. I think one question that has come in a couple of places is the current environment in the India market, interest rate rise, recession fears. Would it impact fintech growth in India, and should they be focusing on profitability at this stage? I just want to take views.
Okay, so I mean, I can tell you as a broking business, we are a high beta business. So if we were to plot our account opening and match it to the mid cap Nifty, it'll be almost the mirror image. So if markets don't do well, new investors won't come in. If markets don't do well, existing investors are going to become inactive. So it's bound to hurt the industry more than broking industry the most. Actually, the markets were to kind of get impacted because of whatever was happening around the world.
Let me just give an investor view, given that we're pretty prolific fintech investors. Absolutely, the conversation around profitability and sustainability is front and center. And if you look at one of the themes of this survey, that's actually been the theme for this. That said, India is actually at a different point in overall evolution than everywhere else in the world. One, as fintech and financial services, I think we're still a penetration story, more so than anywhere else, where it's been a displacement story of fintech displacing into financial services. And a lot of the fintechs are actually driving penetration. So at least from our view, it is still early days. So it will need investment across fintechs, and I'm not talking about wealth tech in particular, but across fintech, it will need a period of investment before we can say that there has to be profitability in that particular category. Now, I think the answer is very different for category. I think lending is a very evolved category, so their profitability is potentially here and now. Payments, that answer is needs to be more immediate given the size of volume. I think with wealth tech and insurtech, I think we're getting still in a period of investments right now. I saw another question, which was around sort of product expansion, and we've seen product expansion as the answer for across all categories. And that was surprising to us till we started doing conversations with the founders. And what we realized is that the founders are using the product expansion to drive revenue and profitability. So it's revenue and profitability top of mind, but then the answer, because given the constraints that they have, they're not making as much money in the product they are offering. They're expanding into other products. So payment guy expanding into lending in order to drive revenue and profitability and so on. So that's the context of the product expansion is what we realized.
I just had one thing. I mean, one has to think like that, and in the context of that, the profitability. They're thinking like this, that just because I have clients and I have a distribution capability, so I should enter manufacturing to build or strengthen the revenue model. I mean, that's not the right way to look at it. Building a right to win in manufacturing is substantially different than the other business. I mean, it's a different game altogether. So I would say platform or partnerships would be a better way than thinking that I can manufacture and make more money because I have clients and I'm not making money on that side.
And there are Vikram, to your point, I think it's not like a singular thing, right? If you look at even Welltech, we feel that in the solutioning space, there is still a long way to go. There are not enough options for investors to deploy capital into places where they don't have to apply themselves. And therefore, for models like ours, the unit of economics is the actual AUM that you're managing and how much money you make from that AUM. And therefore, obviously, the inflow gets impacted by markets. The AUM, the stock of AUM that you have also gets impacted by how market movements are, right? But the impacts are different. It's not as acute as probably what you would see in other spaces. So therefore, for us, the focus is around how much do we make on that AUM? What is the cost of acquiring that AUM? And what is the cost of acquiring incremental AUM from the same user, right? And around that, if we can build a sustainable model, I think there's a lot of opportunity.
Yeah. And maybe, last question, Sandeep, Yatin, one of you can take it. Is it now time to open up investments to more cross-border opportunities? Is it time that Indian investors have access to more opportunities of investing, outside of India, and what needs to be done with that?
I think it's been gaining momentum, and every time a bit of acceleration happens, rupee depreciation. I think more awareness come. I should have taken it last year. Of course, there's an annual limit, what we call is under LRS, Liberalized Remittance Scheme, which you can take $250,000 per account. Now there are also, of course, multiple options which are there. One is way to take money outside for not just investment diversification, but also you have some money from a capital account convertibility outside your home country. And there are ways of exposing yourself to international investment opportunities, which is SEBI has been very proactive and allowed foreign funds feeder to get launched in India. And that's been huge. You've seen that limit getting blocked recently, but now opened up again. But that's a huge success, which we saw by Indian investors taking the diversification route on investing in India. And now the third fund, which is opening up, which is the GIFT City. I think that's again will allow more innovation in terms of platform products, both in terms of what flexibility it will offer for both investors, inflow and outflow, I think.
Okay, last one for me, for all the panelists. In one line, one sentence, what is your mantra for sustainable growth for Wealthtechs? One line.
2 words: customer centricity. I don't know. Think about them all the time, and I think the rest of the things just fall in place.
Yeah.
Low CAC.
Yeah.
Low CAC.
Solutions, more solutions to get them engaged.
Yeah, and for me also, user-first thinking, Mayank.
Yeah.
Seems
like 3 words putting it
All right. Thank you very much. Thank you all the panelists for taking our time. I really learned a lot from the discussion today. I think there is a great alignment in terms of the agenda that the industry is looking at taking forward. Anything, Vikram, that you would like to add?
Thank you to all the panelists, and thank you to the audience. I know we spent a lot of time. I saw 175 people tuning in, so appreciate it. Our next panel will be around payments, and then we have another one coming around neobanking. So look forward to that.
Thank you, everyone. Thanks.
Thanks. Thank you, everyone.
Thank you. Bye.